I think it's going to be a great discussion. What is a REMS student? So maybe if that becomes a part of the discussion, but a REMS student who, it's a part of the application process, they apply to be it, and it's a very, very selective process, but basically you are admitted from high school into the URMC, the medical school here. It's a direct admit program. I think there's less than 10 incoming cohort. Very selective process. Did not end up going to medical school, clearly. So, all right.
Not all of the less than 10 end up going.
No, that is very true.
That happens every year, not just for me.
No, that is true. You're not the only outlier there.
When I ask and when I hear other potential students ask on tours about what's the REMS program, the tour guides are trained to respond, don't even bother applying. You're not going to get it. So
that's very
I'm
true.
I'm fortunate to have got it in.
I know, very true. It's very special to get into that, that's for sure. All right, Harris, I'll let you take it over from here.
Sure. So Jody asked me to put together some materials on technical workshop on financial modeling and performing a detailed financial analysis. I took the prompt, I read the prompts. I think I read the next sentence, but maybe I didn't. And I took in a little bit of a different direction, put together and modified some of the Bain Capital proprietary modeling and valuation slides. So hopefully able to learn a little something that you're not used to seeing here today. So the agenda I put together is, first I'm going to talk a little bit about myself, maybe just as helpful as a presentation, just learning another alumni's story of how they navigated their way into the role they are in today, and potentially informative on the path that you may navigate. Then I'm going to talk about how I think about valuation, how we think at our firm about valuation, how we act on that thought process and put together a mini model. I'm not going to walk, we generally build full detailed models, but it doesn't look too different from the 10-minute mini model that we put together. How we apply modeling to drive decision making. And then I'm going to talk very briefly about the context in which we make investment decisions, in case that's interesting to you. So right now I'm on Long Island. I'm from Long Island. Applied to the University of Rochester because of the REMS program, and I wanted to go to med school. I was a total science geek. I knew I wanted to be a biology major and do everything related to science. And so I spent all my time in a research lab, probably my freshman, sophomore year, with the idea I didn't want to be a traditional physician, but wanted to do something a little different. So this is probably a close representation of what I looked like when I walked into Jody's office when I was thinking of doing something a little different than becoming a traditional doctor. I even have I got an A in anatomy shirt on. I probably didn't wear that, but, and started thinking about finance. I got real involved in MelCap. I was the managing director my junior and senior year. Got an internship in healthcare venture capital, which I thought would be a good way to dip my toes into the finance aspects when I was really familiar with science and biology before that. And what I thought was really cool about what they were doing there was taking a medical innovation, a drug that was helping a ton of people, and saying it's worth X. And this idea of translating technical understanding, scientific innovation to value I thought was cool. And so I realized that in order to really understand valuation, I needed to get a boot camp training course, which I learned to be investment banking. So put in all efforts I can, and Jody will testify to myself and my peers, the there's an article, I forget where, it's the Wall Street Journal, 1,000 emails to get to Wall Street, and that was my journey and others' journeys. Navigated an internship at UBS in their healthcare investment banking group, got an offer there and leveraged that to get an offer at J.P. Morgan. Spent 2 years at J.P. Morgan, and it was just what I wanted it to be, which was a boot camp, which you read on paper that it's a lot of hours and hard work, and it's a lot of hours and a lot of hard work in investment banking. But luckily, was fortunate to be in I think one of the strongest shops in technical valuation at J.P. Morgan, and thought I was deferring the med school and going to go back after once I had my training course in me. But realized there was opportunities to do just what I wanted to do, which was get a little bit deeper in the science, translate those deeper insights into a better informative view on what's it worth. So really, I wanted to be asking, will these things work? And if they work, what are they worth? I'd been training in the what's it worth, and I wanted to get deeper in the will it work, and found that there were opportunities to do that out of investment banking without the need for a professional degree. And so look at that. That's me and my Bain Capital photo shoot. I should put another graphic with the line, University of Rochester Career Center, where Miss Green told me a little picture of Miss Green telling me the next time she saw me, I needed to have my hair cut, or she wouldn't speak to me again. But it all worked out. And I've been with the Bain Capital Life Sciences team for 3 years now. Hoping to stay on and continue growing there because it's a really great firm and organization. Bain Capital has 100 billion plus assets under management. It's traditionally known for being a mega fund private equity shop, and they had started this life sciences focused fund looking to do venture capital, growth equity type investing in that niche. And so for me, it was the perfect opportunity to take what I knew from banking and apply it into a more technical context. And it's been just that. It's been an awesome experience, and I can probably talk for another, however long I have to talk today just on that. But I'll shift over into my learnings from both J.P. Morgan and Bain Capital, and what I've learned about how I think about the what's it worth question and how I break it down. So just to clarify what I'll be going through, hopefully this is applicable to students who don't have who are just kind of learning, say they're interested in finance but don't know much more than that. And it's applicable to students who have investment banking interviews tomorrow, or starting investment banking internships, or are moving on to private equity jobs. But what this is not is, I'm not going to teach you basic finance and accounting. I'm not going to teach you how to build a DCF from scratch and what to answer in your interview questions. There are really, really great programs that can spend more than an hour on that. Good textbooks. I don't have the latest on what the best resources is. Career Center might have that. People who are a little bit closer to investment banking may have that, but that is worth, outside of your coursework, spending the time, energy, and however much money you need to spend. I found PDFs online to do so, and just sitting down and learning, because you're not going to pick it up in a context like this. But how I think about valuation is, there are really two ways to value a company. To ask the question, what is something worth, and it's how much is someone willing to pay for a company, which is a multiple, for every dollar of revenue, for every dollar of cash that they make, how much I am willing to pay for that dollar that they make. And then there is the fundamental builds to that would be some probability adjusted and get to what its true value is. The one thing that I'll acknowledge is not on here, and one thing in investment banking that I think about it is something that we like to call football fields, which is you put the different valuation forms on a page in the range of values that are appropriate for a company. The one thing that's not on here that I'll just acknowledge is a leveraged buyout, or an LBO, which is how much a financial sponsor would be willing to pay. I don't use that on a day-to-day basis. I don't know how to quickly evaluate or think about that, but it's something certain teams within investment banking will definitely need to know and will build off of. So I'm just going to acknowledge it. But turning to what is someone willing to pay for a company, what's in a multiple? A multiple is the total valuation of a company for every dollar of revenue or every dollar of profit. If a company makes $100 million in revenue and people are willing to pay 10 times that, then the company is worth $1 billion. It's a shorthand valuation methodology. It's good because it's shorthand. And when I am quickly looking across companies, or I want to know realistically how much companies are valued at without making a bunch of assumptions, I'll turn to a multiple-based valuation. If two companies both make 100 million in revenue, let's say growing at the same rate, what multiple should you apply to that company? If you have information, I guess, down the income statement, you want to use it. So I'll always look at the PE multiple, which is the price per dollars earned per share, because that's farthest down. And if two companies make 100 million and one of them makes 50 million in profit and one of them makes $1 in profit, obviously the one that's making more profit is worth more. And so you want to look at them on as close to an apples to apples basis as possible. If neither company is profitable, then you're gonna use revenue. You're gonna use the topmost you can use. If you have no financial information, then you can use a future sales figure and a multiple based off of that. The next piece is who is the person who is deciding how much that company is worth. That'd be trading comps. That's asking the question, okay, there's companies that look pretty similar to this company, and they'll pay 5 times the revenue for that company, and therefore this company should be worth 5 times revenue. The other way is, okay, companies like this have been bought for 10 times revenue, and therefore they're worth that. The caveat to the transaction multiple, which is also important because strategics are the determinants of what a business is worth to them, is that there's a premium baked in there because a company is paying a premium to own that share of cash being produced. So that just has to be factored in when you're thinking about what is a company worth. And so one thing that when I started to really understand this, and I thought about and I debated with peers at J.P. Morgan, was, well, why is this company worth 10 times? Why is this company worth 7 times? And the answer is the companies trade at what they trade at. They get bought for what they get bought at. There's really no rhyme or reason except that's just what it's worth. And so that's where the DCF is really important. The other factor that goes into why is a company worth, to qualitatively characterize why a company is worth 10, why one's worth 7, why one's worth 5, is these are this is what one of my bosses like to use, the ilities of what's in a multiple: scalability, visibility, sustainability, profitability, credibility, reasonability. Basically the soft factors that can lead towards a company trading towards a higher multiple without any increase in how much dollars they are producing. If investors or strategics think there is a clearer line of sight, if they think there is a better steward of capital running that company, they're going to be willing to pay more to own that cash stream. And therefore, a company is actually worth more. Even if the same business is producing the same amount of money, if there's a change in how that cash stream is viewed, then it's a change in how it's valued. So this is a soft way of thinking about how much a company is worth. And the DCF is the hard gold standard methodology in valuing a company. It's the sum of the probability adjusted discounted future cash flows. The sum of the probability adjusted discounted future cash flows. That is the goal. That is what a company is worth the cash it makes. $1 today is worth more than $1 tomorrow. If you hear investors, if you hear people in banking, hear anyone in the industry speaking differently to this, then you know a company is being under or overvalued, and that's usually an opportunity to make or lose money, is when a company is starting to disconnect from the actual cash that it will one day produce. And so to break that down further, company brings in money, revenue, converts that money into cash, and then that cash is going to stay, it's going to grow, it's going to go to zero. And the time over which that takes and the probability of those cash streams happening are what a company is worth. So to compare the two methodologies, DCF is the gold standard, but you're making a lot of assumptions to get there and you're prognosticating into the future. And so a lot of people will say it's garbage in, garbage out. I don't know what is right. I don't know if the market's going to grow by 1,000%. I don't know if it's going to grow by if it's going to decline. And therefore, I don't want to make a bunch of fake assumptions to get to a fake answer of why a company is worth what it's worth. Whereas a multiple is shorthand, it's easy to use, you're relying on what actual companies are being valued at. The problem is it's subject to context. If everything is overvalued today and you use a multiple, the company is also going to be overvalued or undervalued. So the valuation methodology should be consistent. One thing that irks me, and also depending on the situation, it could get me excited, is when someone says, well, companies like, this is a fast growing company and it's trading at 100 times its earnings. But all companies like this trade at 100 times its earnings, so it's merited. But if you can't build a model, if you can't project what cash that company will produce and get the values to match up, that company is overvalued. It doesn't matter. All that's telling you is that other people are also too excited about the company. And I put this quote on the first page because I really like it, and I didn't say it, but there's a difference between a great company and a great investment. A great company may be perfectly valued and may have a really high valuation. If everyone thinks that the cash flows of that company, if everyone loves the management team, if everyone thinks there's no risk and it's sustainable cash forever, and that's reflected in the valuation, you're not going to make money. Investing, either strategic investing, strategic acquisitions, investing at a hedge fund, investing through private equity, is price arbitrage. It's recognizing opportunities where you could buy low and sell high. And And so appreciating when there's differences and understanding the differences between the multiple and the DCF are really important. So I'm just going to quickly run through a mini model. And a mini model is the fastest model you can put together. And the Bain Capital Life Sciences, one of the philosophies, is the first model you put together and you spend 10 minutes on is probably 80% right. And you can build a tremendous amount of, you could build 10 tabs and every dynamic switch and you could put macros in your Excel, but if it boils down to the mini model, it boils down to the elements we talked about, which is how much revenue is produced, translation of that revenue into cash, and the discounting of that cash over time. So what I put here together is I put in fake numbers and a quick, really quick, the quickest mini model I could put together. You could probably take out a piece or two in here and make it even faster. But I'm going to walk through each of these pieces to show how I think of making a really quick and really accurate DCF. So this is, again, this is looks like there's a lot of numbers on this slide. It's boiled down into the same paradigm that I showed before: revenue, conversion of that revenue, and the durability of that revenue over time. So how do I put together what the revenue for a company is? And this should apply to any industry, any space, and every industry is going to have more detail beyond this. So it's, what's your total addressable market? How much share of that total addressable market will this product attain? What's the market share across the widget producer for their penetration? And that translates into how many widgets of, widget is just a general term to say any unit, any cog, any good sold, times what the price of that is, and that's going to get you to revenue. So I on the right is a revenue build that I had put together for a company we were evaluating for a hemophilia B gene therapy. And a company actually literally right before this call just bought the hemophilia gene therapy for like $2 billion. So maybe under, maybe overpaid, depending on this build on the right. But this is super, hemophilia B gene therapy is a super specific example of just something that can fit into this model. It can be anything in the world. And when we're looking at any new business, taking this very basic framework and trying to squeeze whatever new complicated business model you see into a very simple framework like this is extremely helpful for decision making. This is a Bain Capital slide which speaks to every business, every commercial story is a 4-chapter story. It's the size of your total addressable market and how that grows, the company's ability, position within the market, and its ability to impact the position, pricing and the sustainability of that pricing, and any potential discontinuities or anything that can change that business. In pharmaceuticals, we think of like, the first would be how many people have a certain disease, how a therapy is positioned in that disease, how drug pricing will evolve over the investment horizon, and then is there any new competition that can come and disrupt that? Can there be a patent dispute and the same technology competitor comes to market? As you get to more complex business models, trying to squeeze them down into frameworks like this make it really helpful for thinking about the business altogether. The next piece is the operating expenditure. So from the revenue build, each company is going to have, in different industries, are going to have different flavors of this, but the elements, at least that I think a lot about, are cost of goods sold, and that's going to be how much it costs to make the good, to make the product itself, any research and development, ongoing expenses, sales and marketing, general and administrative. These are the things to look at within any financial statement. And the key here, and this is going to be something you hear a lot if you take any investment banking prep courses or read any textbook, is you want to look at continuing expenses over time. Anything that's going to continue into the future and isn't a one-time expense to carry forward in your valuation of the business. The next piece is converting EBITDA, which is earnings before interest and taxes and before depreciation. And with EBITDA, there's a word we use a lot, is the best proxy of cash flow prior to when debt holders get their hands in there and when taxes come out. And when looking across different businesses with different capital structures or across different geographies, they're going to have different different tax rates. They're going to have higher interest rates, lower interest rates. So when thinking of what's the right point in the income statement to look at a business, EBITDA is the best proxy in order to look at companies equally before you take out those pieces. So after EBITDA, you take out the pieces, or you take out all everything after before. You take out the taxes, take out depreciation, capital expenditures, changes in net working capital. I'm not going to go into those elements right now, but are depending on where these are all really important elements to know for investment banking interviews, for on the job in investment banking, and not forgetting these things is like a crucial element to valuing a company. And then you take the cash that's produced and you bring it back to today. So the discount factor, the basic principle there is $1 today is worth more than $1 tomorrow. And you use a weighted average cost of capital to discount back. We don't think about the weighted average cost of capital a lot. In investment banking, they will think about it a lot. And so I'll leave that there, but that's something to explore further, and what's the appropriate weighted average cost of capital for the business. Basically, if you invest your money elsewhere, how much money would you make? And therefore, that's the value of $1 over time. And then the terminal value is at the end of it, at the end of your projection period, what are you going to grow your cash at? What does this look like? What does this business look like into perpetuity, into infinity? And is a critical assumption for how you think about valuing a company, because obviously if you think the business grows forever, then it's going to be worth a lot more than if it declines forever. Typically, you'll want to build your DCF until a point where it's appropriate to slap a perpetuity growth rate onto it. Because if you do it anytime before that, then you're going to be misappropriately valuing the business. So each of those components, the revenue builds, operating expenditures, free cash flow, conversion, and discounting, flow into your DCF. So I'm going to talk a little bit about how we at Bain Capital Life Sciences apply the basic modeling to drive investment decisions. And so this is probably less relevant for investment banking specifically, but is an interesting way to think about how you invest otherwise. And as you move on to potentially other career paths, private equity, or investing with a venture capital firm, investing with a hedge fund, this is where this is more relevant. Because the most common criticism towards modeling is it's garbage in, garbage out. You're applying a bunch of assumptions that you don't have, that completely change the answer of what a business is worth, that you don't have that much foresight into. And so we think we do a lot of modeling. A lot of other firms in our space don't model a lot because we think of the model as a way to better think. We use the model not as the answer, but as a way to think about a business. To make a good investment is to have a differentiated perspective on the valuation. You're buying a business that is worth more than it's being traded at today, either in the private or in the public setting. To have a differentiated view on the valuation, you need a differentiated view on one of the core elements that drive valuation: the cash that it's producing, the multiple it's trading at, or you have a thesis on the balance sheet that the company, something related to the balance sheet. The company has not enough cash to get through, that's differential from the rest of the market, that's differential from consensus. So either you think the revenue is going to grow faster, you think it's actually going to be margin expansion for the multiple, you think people aren't valuing this company, people are valuing this company like a company that's slow and not going to grow, but they actually should be putting a multiple on it for a fast-growing company. An investment thesis where you state, I think this company is good, is a bad investment thesis. If everyone thinks the company is good, you are not making money. In order to create alpha, in order to make money, you have to have a next level thinking on an element of the company's valuation. When you read news that some bad event has happened to a company, the first thought is, wow, this is bad. The value will go down. If you're going to make a smart investment, you have to think, wow, everyone else thinks this is really bad. I don't think it's that bad. I'm going to buy, and it's going to trade up. Or, wow, everyone thinks this real event is really, really great, and this company is going to make a ton of money, and that's reflected in the valuation. But it's actually not as durable as I think it is. I'm going to short the company, or I'm going to sell the company because it's above my fair value. We then break down critical, in our space, this model really works well, which is breaking down key inflection points for the company into three pieces. What is the time capital risk that I'm taking? How much time, how much capital will it take to get to the key inflection point for a company? What's the probability of a good event or a bad event at that inflection point? And what's the upside downside at that inflection point? We generally like to invest in inflection points where we think there's 3-to-1 odds that we're right, 75% probability of success, and there's a chance, and the weighted average return will be 3 times our money. And you can set different disciplines depending on what your risk tolerance is, but we think of every event in these three contexts and apply each of these when we're building our modeling. So if you look at a company over time, this is trying to map out here companies' value as they decrease the risk and they go and they have success over time is this smooth line over time where the risk goes down and the value of the company goes up. And we think of that smooth line as actually discrete value creating events where you want to invest ahead of key inflection points, key value creating events that you have a good sense of the time capital risk that your investment is providing, that there is asymmetric upside to that investment, and that you'll be rewarded for taking on that risk. So if a company is going to take too long, if company is going to take 10 years in order to get its product out, that's the capital that it has on hand may be not sufficient to fund to the inflection point. If it's a 50-50 chance, you may not want to take that risk. And if you're right with that 50-50 chance, you're not getting paid for taking any risk. That's a poor investment. So you have to we set the 75% benchmark and the 3-to-1 upside as the benchmarks that we'll take internally on making any individual investment. And so going back to this is a graphical illustration of what I was speaking to earlier, but we don't just invest in a market and say, this is a good space to be in because we think this technology will work. We'll invest only in clear inflection points where we think there's 3-to-1 upside that we are rewarded for taking on that risk. And what we'll see a lot in biotech specifically is places where the company is trading at or valued at beyond their fundamental value. And so that's this froth illustration where there's more risk than being captured in the valuation, and we'll avoid opportunities like that. So one of the key Bain Capital philosophies and how we make investment decisions is we will put everything into a fan of outcomes. We'll say, this is our downside, our base, our upside scenario that we think will happen as a result of taking on the risk for a certain inflection point. Instead of asking the question how in investment banking DCFs are built, they'll build DCFs and say, what is the business worth today? We'll ask the question, what is the business worth at when we're exiting the investment? What is the business worth at a future point in time? And we'll look at discrete states of the universe, a state of the universe where either everyone's buying the product or the product works phenomenally well, a state of the universe where the product works as expected, as we predict it will, or a state of the universe where everything fails. And what is our return under those different states of the universe? And a lot of times when there's so many different states of the universe that putting it into 3 discrete buckets is the wrong way to think about it. We actually do these complex statistical models to create an actual histogram fan of outcomes. And you want to invest where there's right-hand skew, where there's a better chance that there's a really, really high return towards your investment than there is that there's most of the outcomes, the modal outcomes are lower hand skewed returns. So this is an example of in a clinical trial sense of a decision tree that we'll build to capture our returns that we'll make. And everything here is MOM, is money over money. So we like to ask the question, if we invest $10 today, what will that be worth at the future when we're exiting? And we want to hit 3 times our return. And then the IRR is just, if you were to discount that return back, at what rate would you need to discount it to get to 0? Private equity and most hedge funds try for 20-25%, or at least above what the market is returning at. And so if you look at this decision tree, what we did is we looked at the probability of the trial working under different scenarios, and those result in different future states of the universe, and what our return would be in those different future states of the universe. So we're asking a couple questions, and it helps us think about how to invest in companies, because we ask, is it going to work in this trial? Is it going to work in this trial? Is it going to be bought? And these are the different outcomes we can be in, and is the net sum of that something that we're happy with? If you don't know how to think about clinical trials, this was a fan of outcomes for a commercial stage business. And you can see here, the fan is, we picked different buckets. This was actually a company we invested in. It's a Korean aesthetic company in Botox and fillers. And you see here that we picked different states of the universe where they are global company. They've expanded into a bunch of different markets and they've succeeded in those markets. And we put different weights to those cases and different return profiles on those cases to come up with a net picture is, okay, this is the range of options, this is the weighting of those options, and this is what we think this decision will result in. I'll stop there for any questions. I'm part of the Bain Capital Life Sciences team. We invest in unmet medical needs, early stage life sciences companies, in early clinical development, a couple different strategies for our investment, but essentially what we're doing is we're asking, if you look back to how we think of our fan of outcomes, we ask, will clinical trials work? Will drugs provide benefits to patients in a clinical trial setting? And then we also ask the important question of, if they do provide a benefit, how much is that worth? So we have an interdisciplinary team of people with backgrounds like myself, people with backgrounds, PhD scientists, drug developers, and we work hand in hand to ask those two questions to try to make smart investments and try to arbitrage the price on early stage private and sometimes public companies. Yeah, so I'll stop there. If there are any questions, happy to talk about anything else.
Thank you so much. I really appreciate that. And I will say that most of that was well over me, but that's okay. This isn't for me. I'm reminded how smart I'm not. But any of our student participants, if you have questions, just go ahead and unmute yourself and just ask Harris.
Question. I'm wondering how do you assign likelihoods to the different scenarios? You know, the different stages of the world that you sort of talk about. What do you base the likelihood on the different cases?
Yeah, so that's a topic we debate a lot. There are some really scientific ways of doing that. When we're looking at clinical trials, we can look at how clinical trials in the past have performed in a certain therapeutic area and say all trials at this stage of development, over all of them, they have a 30% success rate. The problem with that is when we're looking at a specific company and we think that specific product is going to work, then why would you look at what other products in different trials have done? It's not relevant. So weighting cases is a lot of gut. It's a lot of, and like everything in a model, and when you break down every input into a model that isn't a scientific input of the company is doing this and this is 100% true, it's a lot of prognostication, speculation. And that's why people rip apart the models as useless, but it's a model for thinking. It's a model for making, how do you make any decision of anything that requires understanding the future, right? It's, well, I think there is a good chance that this is what happens. I think there's an okay chance. I think there's a decent chance, a coin flip chance that this case happens. I don't think there's a great chance, but it's possible that this happens. Taking that, converting it into a number and using it to make decisions is what we do. Okay. And what we get better at.
Other questions?
Hi.
Go for it.
So somewhere in the presentation, you talked about like how the revenue is very, let's say it's a cornerstone of, it's an integral part of the way you do your valuations, right?
Yeah.
So, and immediately I had to like stop and think about the tech startups where usually it's never about the revenue per se, but it's more well, I've never really been able to understand exactly what it is, but it's, I think, scalability for the most part, and user engagement. So, and I know like for Silicon Valley and the financial world of J.P. Morgan and whatnot have been at,
Yeah.
they don't really agree on those terms. So, but eventually, obviously, when a company like GitHub was being bought, I'm sure there are some people from J.P. Morgan at that table. So how do you usually get up? I know you're in the life sciences space, but this must be something that you're engaged with a bit. So
Yeah. Totally. Even in the life sciences space, we're forced to look at businesses where it's not as easy to think of how they make money. And when we look at the more complex business models, especially making decisions of whether or not you want to put your own money in, gets kind of hard. So the key thing that we think about, especially if you're looking at, let's say, a Snapchat, is how does Snapchat make money? And then you would come up with a revenue build for how Snapchat makes money. Let's say if Snapchat has 1 million users, then they can charge $1 per user with ad brokers. Or let's say there's you would take each potential source of cash, each potential revenue stream, and try to break down, okay, how many users could Snapchat access? How many people are between these age brackets? And how many of them use Snapchat today and are likely to use Snapchat in the future? How many of them, how deeply will Snapchat penetrate into the market? Well, are there other photo sharing services? So what's Snapchat's market share across the users that'll penetrate in? And then what's it be charging to ad brokers, and how could that price evolve over time? I spent a lot of time looking at life sciences, and that's when I can speak to the best, especially given my background. But these are tools and ways of thinking that can apply to any business and should apply to every business. And if the thought is, well, it's a complex way of making money, I don't know how it makes money, and so I'm going to say it's new and it's worth $2 billion, then there's a good chance you could be disconnected. Either you're too low or too high. But trying really, really hard when you're making a decision where you're putting your money behind something, to break it down to, okay, how is this company going to make money, and what's a way that I can tangibly create a framework for thinking about how they'll make money is critical to making any investment decision in any space.
Made a lot of sense. Thank you very much.
Any other questions out there before we let Harris go?
Maybe one could have been, while it's not related. By the way, are these slides uploaded, or do you plan on uploading them?
So
I could share them.
Okay. So if you want to send those to me, Harris, I can send it to everybody who's logged in today. If your Zoom account isn't connected to your U of R email address, you're going to want to email me, and I can send it to you. We've recorded this, so we'll get it onto our YouTube in the next day or two as well.
All right. So one last question would be, what strategy and maybe overarching plan would you give someone who wants to get into private equity? I'm sure that getting into it from straight from the undergraduate it's pretty much impossible. But then, what would be a step-by-step strategy?
Yeah. Getting into private equity, getting into a job in investment banking is tough. There's only a number of people who get it per year from any school. Getting into private equity is the next level, tougher. I think James Frown is also with me here at Bain Capital now, but I think I was the first University of Rochester person to work at Bain Capital. There's a lot of Harvard folks, if you can imagine, in Boston. But the roadmap that is most traversed is job in a top tier investment bank or a top tier consulting firm. From there, and I can get more specific, but most private equity firms, or at least top tier private equity firms, are going to recruit from the best investment banking or the big three consultants. There are a lot of other private equity firms, and they have a lot of different investment strategies, ways to make and really interesting jobs and ways to make a tremendous amount of money in different contexts that are out there. But the general trajectory that I see is people are at a top tier investment bank, top tier consultant. Your first month on the job, and it gets earlier and earlier now, you get emails from a recruiter. Everyone gets them on your team. You go into the recruiter, you give them you give your pitch. You have to pitch yourself to the recruiter. The recruiter shares names and is the first filter for private equity firms, where they will all activate at once and have what's this week of super days where every firm interviews at once and you're flying around the country, and they grill you on finance, accounting, building, leverage buyouts, before you've even learned and before you've even done them on the job. So the best way is to get into private equity is to know what that trajectory is, know what that typical course has been, and being prepared when you get into any interview setting to excel. Coming from the University of Rochester, the individuals my peers in finance who have succeeded aren't just the top of the top from University of Rochester. They're the top of the top in their classes at wherever bank or whatever investment firm they're at. They are more prepared than anyone else in the room. They didn't come in with a chip on their shoulder. They worked really hard to get in the position they're in, and they're working really hard to get in the next position. That mindset, you need any interview you get, you need to execute, and you need to use to its fullest extent. So really being prepared on technical valuation, leveraging the Career Center, leveraging your network, leveraging networks you build in order to get into the right door. Those are the general sentiments I'll share of the best way to get into private equity. I'm in a different fund within a private equity firm, so my road was a little non-traditional. They were looking for someone with my phenotype who had background in biology, and was a good I was a good analyst at J.P. Morgan, who my bosses liked and recommended me. So I was in the right place at the right time. I got lucky, but I was ready to execute when the moment came.
I see. Thank you so much.
All right. Well, I want to thank Harris very much. I really, really appreciate you taking the time. I know you're probably incredibly busy working. So thank you. I know you are, right? Oh, there's Abby. Sorry, I promised she would make an appearance. Sorry, Abby, stop. But thank you so much. I really appreciate you taking the time today. And you've done so much for us, so thank you again for being everything you've done for the Green Center and volunteering like this. But that is all. Thank you so much, everybody.
Yeah, anything that I can be helpful with, reach out, Jody, and if any students want to reach out, please do. I'm always happy to talk.
Thank you very much, Harris, and all your free time, right?
Yeah.
All right, everybody. Thank you, and have a great rest of your evening.
Thanks.
Thank you all.
Bye.